Hello, guys. Nice to see you again. Good afternoon, everyone. Welcome to today's webinar, Macro Inflection Point Blow Off Top, Setup or Structural Breakdown. My name is Yann Allemann, and I'm joined here by the one and only Willy Woo and Henrik Zeberg. But before we begin, we just want to make sure that we give you a couple of insights in terms of what we do here, and we want to make sure that you don't construe any of what we say as actual financial advice. We make sure that everything that we discuss here reflects our personal opinions at the topic at hand. Always conduct your own research and consult a professional before making any financial decisions. Participation is voluntary, and the information provided is indeed for educational and discussion purposes only. Today's session, like we always try to do, 45 minutes of discussion. We'll start it off with Henrik, look at the global macro, go a little bit more into the liquidity flow related topics with Willy, and I'll try to top it off with a little bit more of a deep dive with the actual Hawkeye, which I think this time around is going to be very helpful. And we'll try to do between 15 to 25 minutes of Q&A at the end.
All right. Good afternoon or good morning, whatever it is your time, everyone. Let me just start out by saying, I have said for a long time that we're going to see a very large crisis unfolding. I've said we're going to see an end to a blow-off top, and it's going to be one of the worst bear markets we've seen since the 1930s. And I 100% stand behind that. I think we have a setup that is perfection. It's the perfect storm. We have debt levels around the world that are extreme. We have a stock market that is so overvalued, we can't even, talk about it. We have a centralization of value in a few stocks, which we only see into massive tops. We have an economy that is rolling over. 62% of the U.S. population is living paycheck by paycheck. We have all the things. We have all the indicators in place. We have my business cycle model, which has been telling us since November last year, we should be starting to see a deterioration in the coincident indicators, which creates a toxic environment. That's what I said. And we are now getting there. But this is not it. This is not it. What do I mean about that? I say that there is another bull run, and it's going to be very, very strong. It's going to be very short. We don't have a lot of time. But because of a lot of things, a lot of catalysts, you can say, which will be a declining dollar, yields, and so on, and also the TGA pool that we will see potentially start to again flow, we should see a massive reversal, and especially because we have now the sentiment is extreme. So we have a situation where everybody feels that this is the thing, and when that reverses, everybody will start feeling, oh, it's not. We dodged the bullet, and everybody will become bullet right into the top. So this is the sentiment. This is the psychology around this, and this is perfect to set us all up in a trap where we feel this is it, and then it's not. That's how I see it. I will start and I'll give you a few indications of why I see it like I do. And I'll just share here. And this is the business cycle model of December, early November. And now we're starting to see some of the coincident indicators coming in for September and August. We saw yesterday that we had the non-farm payrolls for September, and they were all of a sudden 119,000. Fantastic number, right? It's an amazing number that we all of a sudden can rise to 100 and what was that here? So we see the non-farm payrolls. You can just take a look at it here. We see how when we have an economy that is declining, we see that it drops. And we had all of earlier this year, the Fed telling us how strong the economy was in Q1 and Q2, only to see in August, all of a sudden, we had to revise all of these numbers, and it's not so strong. Minus 13,000, that is terrible. That was in June. Now 79,000 is still holding, apparently, in July. Minus 4,000 all of a sudden in August. It was plus 22 last month. Now it's been revised. And then they try to tell us we have 119,000 like this out of nothing. That is not how the economy works. The economy works in cycles, and it moves up and down this. The leading indicators are telling us that the Titanic has hit the iceberg, and we are now seeing that deterioration coming into the real economy. The Fed is terribly, terribly late. They are afraid of their own ghost of inflation, and that's why they're afraid hawkish for way, way, way too long. But the situation is that they will have to turn bearish soon, or bearish in terms of the economy. If they don't, then they will simply just, cut off the liquidity to the world, because that's what they are doing right now. They're sitting and looking at inflation, which is a terrible situation. So right now we have a situation where the economy is clearly deteriorating. And remember, we also have all the discussions with the liquidity tips right there, out there, right? And remember how we're saying that we're not seeing a recession coming. We're seeing an economy that is recovering. Remember that the liquidity is going to save everything. Look at this. This is not what it looks like. We even have the momentum now turning up very strongly here. This is not what you want to see on the number of unemployed people. We can look at the unemployment rate. Same thing. Unemployment momentum is now clearly turning higher. Guys, the recession is coming, and it's just about when. So now we have to say, okay, but Henrik, why is it then? That's the other one. He tells me, why is it now then? And I say, well, because there's always this last dance before we see the real settings, and that's where we have to turn into some of the charts of the on Bitcoin, for instance. We have had this strong decline here now, and it feels terrible. And if you look at that, obviously, something that is down 40% or something like that, that's not a good thing. It's 30. What is it down actually? I haven't checked it from the top here. We're down 35%. That feels terrible, but that's not the same as we cannot see a very strong rally coming in soon. And I see it that the equities also have had a decline. We are now at, if you look at sentiment, we are down some from the top here. We were down at the most 6.12% on the S&P futures, 6.12%. And the fear and greed was at 6. That is extreme fear. That is like April fear. So there is an overreaction right now. It does not mean that we are, that the situation is not becoming more and more severe. It is, but we just do not have every indicator we need to see in the market. We don't see stress in the financial market, credit spreads. We don't see yield spreads spiking very strongly. There are a lot of indications that center doesn't show. So to me, this is the setup which we're going to send us soaring higher for whatever reason. What is the catalyst? What Yann says to me all the time. I say, well, we have the catalyst. We have the catalyst of the TGA, of the yields coming down, of the dollar declining also, which I see from here, and of the Fed, which will realize this coming into the Fed meeting. I see that they come and give us a cut. And that is going to send things higher into December and potentially January. But that's the kind of the timeline I have to look into here. I don't think we have much more time. I know people think we have much more, but we have terrible deterioration in a lot of markets around. If you look through the DAX, for instance, the DAX is Germany has been terrible for a long time, but the DAX has been going up. If you look at this now, this looks terrible. And this is a massive, major economy. If you look to the SPX and the DAX together, I mean, they are moving like brothers and sisters or, siblings. So if I can find it here. So if the DAX is going to turn out at a major top, like here, for instance, we saw into the financial crisis and so on, we might see that the DAX rolls over first. And I think that's what we will see because we have such a massive top. It's normally the strong US markets that will stand the longest. And that's also what we need to get back to because if we look at things, we would actually see that an index like the Dow Jones topped on November 12th. Would that have been the case if this was the big decline? If NASDAQ topped in October? No. And we have seen other indices also around the world, which have topped out later. The Nikkei, for instance, should also have outperformed the NASDAQ. That is not how it works. So I'm saying the indications are there. There's too much fear now in the system. The liquidity needs to start to flow again. The economy is rolling over, but we are not seeing the imminent recession indicators. But we could see a recession in Q1. I'd say I give it a lot of the chance that we are there. But the final dance will come into the markets as this oversold levels will come into a euphoric move where the psychology will shift completely. And we'll sit on a meeting here in a few months or a month or two. And you'll say, but Henrik, why do you think there's a top? That is how the markets are always turning against us. And I'm seeing this now. There's simply too many indications that this is not the top. There are the chronology of things, the sequencing of things are simply not turning out. We don't have the stress in the market. And the technical analysis suggests that this is a correction, a bad one, but it's going to soar higher. So then coming back to Bitcoin, I think we're going to see a massive rally in Bitcoin and a very fast one. And then you'll say, but Henrik, you can't have a rally of, what is it? 77, 80%, which is my target now, right? I have to take it down because that's what the Fibonacci does when we go lower. 143 is my target. You can't have that in 4, 5, 6 weeks. And then I'll say, you know what? You actually should expect that. Because if we look at history, you will see that we have had that plenty of times. We have had a 70% week here. We had 71 here in 4 weeks, and 4 weeks here, 101 here, 120 here. And by the way, this over here was 100% after we have seen a decline of some 32% here. Right into that, boom, 100% higher. We saw it into the top here as well, 115%. So what am I saying? I'm saying into major tops in Bitcoin, we should expect a very, very strong rally. That is what we see every time. So if I'm saying that we will get a 70% rally here, it may seem insane on the charts, but it's within limits of the reasons. And I think that whole setup we have now is going to send us catapulting in the opposite direction. Worst sentiment we have seen, everybody's so sure. And when that clears a little, people will flock into the opposite direction, and you're going to see the opposite. I think that was enough for me for now.
Let me ask you a quick question, Henrik, because it's a question that also came up in the Q&A here. You mentioned the last time that we saw each other on the last webinar that you were expecting VIX to go up between 25 to 30 as you kind of get that reset moment, readjustment of expectations, right? When it comes to say to the AI, kind of the perfect pricing of AI revenue, AI kind of hyperscaler growth, all of these things. And also a dollar that would top out at around 100, 100.5. We're there now, right? How do you see that evolving? And how does this kind of play into your narrative currently?
It plays right in. I mean, when I say we will have around those levels, that's where we potentially should see the top. And of course, there will be some. I mean, the dollar has been rising quite strongly. We have to understand that. Nobody's really talking about that. But that has been some of the headwind we've seen as well. Right now, I see the dollar has one last decline, but when that bottom comes, and everybody talks about how it's going to crash, that is the moment when we see the market top. There's one more dance in the dollar as well, and the VIX seems to have topped also around this area, as I see it, and we're going to see a decline into the coming weeks, but not for long. So it actually played out rather well, Yann, I would say, and we have had this fear. Did I see that the Bitcoin will go this far down? No, I did not. I didn't see that it will go this far. But it just tells me also, everybody who tells me that Bitcoin is going to save the world, if it can drop from 125 to, let's say, 80 here, based on nothing, then go figure what it'll do when the VIX is at 123. So we should be careful. It's a risk asset, and it's going to fall one last time. But enough about me, I think.
Yeah, I'll get into a little bit of that as well. Go ahead, Willy.
The coincident indicator hasn't crossed zero yet. That's a November print, was it? Like, if you grab that, because I want probably the most critical thing right now is to get the timing signature of a top. And what's the trajectory right now to cross the zero line on the coincident indicator?
That is, I mean, we could have seen it with what we saw with the August numbers, because when they upload those, they will actually push it lower. So we could see it. But the thing is, when you look at it, again, it's not a timing. That's what I'm saying. It's closing in. Let me just share again, guys. Hang on. But thank you for asking into it, Willy. It could be with the update of this. This is based on the latest data we have. But when the data didn't come in because of the US shutdown, of course, obviously, then the models are better than that. But if we have this now, the numbers coming in here, and I'll do the update by the end of the month, you could see that this probably could have crossed. Now, the 119 that they put in as of September will probably make it look stronger, which is probably bullshit. But the thing is, we are getting closer to where this would be, and that's where this can cross. We see how they crossed here in November 19, and it gave us a February 2020 recession. November 2007, December 2007, and so on. February 2001, March 2001. It can also come in May, July. It can also come like 1 or 2 or 3 months before. It can even be late a little. I think and that's why I'm turning to what I call the imminent recession indicators, which are the ones which, when they start to move, we are in a recession. And these are the ones like the stress in the market, yield spreads, and especially the short-term yields. And we don't see that plunging of the short-term yields just yet. That is the one thing, and there are other things also. But there are some imminent indicators that will start to show. Okay, now the shit hits the fan. But we are getting closer, definitely.
I think gold selling off as well, Henrik. Right. So if you see a faster, more structural sell-off in gold, that's usually a warning sign for liquidity constraints. In the system as well.
Yeah, that's why I've said all along. I said when you see a deflationary bust, you're gonna see gold sell off, and the gold people don't like me for that. I was wrong on how far it could go, but the sell off you're gonna see into a liquidity crisis is going to be bad. I think there will be, however, a rotation first into Bitcoin, and I see the Bitcoin gold ratio is going to go skyrocketing in a very short time frame. But I think things will develop really, really quick from here. That's what I'm trying to say, because the time frame is just getting squeezed by the dollar and so on, and by also, I know Willy, you also have some perspectives on that.
Yeah, my perspective is we've got 6 weeks. Because typically, I mean, it's just a guess, right? Like generally the cycle ends by the end of the year. Also, if I look at trend exhaustion, we've got multiple trends that end by the end of December. And so if we've got 6 weeks, then we need to look at where we are structurally. And maybe I
Mhm.
can share the screen.
Six six
But
weeks would fit into my setup also, really, as I said. I mean, it would mean that
yeah,
in 2007, we had the crossover in November, the recession started in December. This time, the stock market topped in October. This time, I think you're going to see stock market maybe topping 2 months later, and that could maybe postpone everything also. And also seems like the business cycle is suggesting 1 or 2 months later, which is quite, would be quite normal. So a little later on the recession, early 26, but potentially with the top in December, January, and then yeah.
yeah. I mean, I'll just pull up the liquidity view. This is the flows coming into Bitcoin. We did actually put a bottom, right? We did put a bottom in liquidity, and you can see that the bottoms come here, and then about 2 to 3 weeks later, we get a bottom here. It's leading, right? And so, like, we have put on a bottom. The question is, when does it turn around? Did not expect this really exaggerated pullback, and that was as far as I can see, two impacts. One was that highly correlated to stocks, right? And so stocks have been pulling back down, and we've been correlating with that, and um, and then we've had a lot of long positions trying to like long supposed bottom, and the correlation to stocks has helped those positions get liquidated and just accelerate the down movement. And so, but like I'm really waiting for this bounce based on liquidity coming back in. And once we see that bounce, the question is, do we see an influx of FOMO coming in? And how high can this go, right? And you can see also this liquidity picture is not looking shit hot, right? Like I would like to see a much higher peak here. So the liquidity picture here is kind of a fizzle. I said last time, many times actually, that this whole price region is being invalidated because it's not supported by liquidity. So now it's corrected back down to the region where we are. So it's kind of completed that divergence. So I want to see this go really high. And if it sort of doesn't go much higher than the previous, then I would call that a top. And I've been saying that this next rally, either in the most optimistic case, we get past a high, that's going to be a bearish divergence and we just reject off it. Or we just hit this one of these resistance levels and that's rejection. We go into the bear market. But we're very, very much in borrowed time. If we look
Mhm.
at this risk indicator, like you can see, you can almost measure the time from here till the start of the bear market. You can roughly gauge it there to there. This is when the liquidity started dropping away relative to the price or the market cap, and um, so the flows coming in relative to the market cap started to not look shit hot. And roughly we're in that zone here, and we are at peak risk. And generally the top happens at peak risk. So I was expecting us to climb because there was solid liquidity. It's got pulled down by equities. Yeah, I've been the most bearish amongst you guys. I would say if you look at past tops in Bitcoin relative to equity markets, Bitcoin usually being more sensitive to liquidity falls away quicker, sometimes leading by a month. That would kind of work. Like we peaked here. Um, you might see a higher blow off on the S&P, but my sense is that we're pretty much it's going to be very hard to break this. in terms of investment, the risk reward is gone here. Like I wouldn't necessarily, unless you're a short time frame tactical trader, like if you're in it for a macro cycle sort of investment where you sell tops and you buy the bottoms over 3 years, let's say out of the 4-year cycle, it's hard to say I'm going to hold on if we get the 140, given we've been at 120, and like it's only a little incremental increase versus this whole thing falling away. Like maybe this doesn't recover. And so that's my view. Is got to consider the region we're in, having come up from 15, 16,000 to 120. Now we're at 83. There is a need for a bounce here because it's oversold. But waiting for the 140, it's discretionary to each individual's situation. But the 140, I don't necessarily think that's guaranteed, given that Bitcoin tends to fall away earlier than equities. I don't think I've got much else to say here. We can look at the flows also, I guess. And this is the orange here is the yellow orange is Bitcoin. You got Ethereum in gray, you got Solana in blue. So everything's in decline right now. So it's not capital sloshing between the buckets within crypto. It's exiting the system. And so it's not a good sign. Have you got anything to add, Yann?
So I think on the flow side, yes, we're definitely closer, like we said in the last couple of webinars, right? Towards the end of the year, we were likely going to see or get closer to a top. I agree with you guys. I did not expect the drop, especially in Bitcoin, to go this far. And I'll make the distinction between Bitcoin, Ethereum, and I would say large and small and mid caps, because there has been a significant divergence. They have been pulled down with Bitcoin just because of the intensity of the selling over a short period of time. But I think we have to look at dissect it a little bit more than just looking at Bitcoin here, because I think it could actually be that I'm maybe the more conservative one among all of us, where we actually don't get a new all-time high in Bitcoin. Maybe we just need 110, 115,000, but a relatively stronger Ethereum and potentially some of the other plays, right? With AI, basically robotics and privacy being the main kind of leading narratives that are pushing through, that also have a lot of relative strength, right? If you look at Zcash, Starknet, some of these other plays, they've held up very well, relatively speaking, to this recent drop. That also being said, in our circles, what has also become apparent is that there are a couple of really big players that have blown up on October 10th, one of them being a market maker, that are potentially unwinding. I don't know this for a fact, but I did a tweet earlier today to kind of explain the structural implications of that. And it feels more like a structured or kind of a mechanical unwinding more than an actual, let's say, risk off sell-off, if that makes sense. And I think we're unfortunate, and this is kind of where things get very obfuscated. We're unfortunate that October 10th ended up being an idiosyncratic structural problem in the space, right? Led by the issues that came up on the way that they pegged the stable coin on Binance. And that basically culminated and kind of converged with a general risk-off sentiment in markets. I'll quickly explain or kind of showcase what that actually looks like. So what we do on a high level, right, as a lot of you already know, that we do a lot of macro-related analysis as well. We have a systematic component to our firm as well that looks at these things in a more kind of specific way, that we're basically scaling up over the next couple of years. And through this, we've obviously gained quite a bit of knowledge as well on looking at cross asset. I think obviously Henrik, from an economic perspective, especially business cycle, is very important. But it's also important to understand the lead lag and the ratios that govern how different assets trade with and against each other. And what we do here is that we aggregate that into a generalized index, right? So we look at about 15 different assets that we basically look at ratios in terms of how they trade. And what you can see very clearly, one of the key interesting points, is that ever since Trump got elected, we've had first of all, a very big shift in expectations that I think kind of started with Trump being very sporadic, the market having to adapt to a much more agile and kind of schizophrenic president, right? That was basically saying one thing one week and another thing or the exact opposite, diametrically opposite point the week after, right? And the constant back and forth, which led to a general risk-off environment. And obviously during that risk-off environment, together with rates that were staying higher without real implications of it coming lower, because the Fed was unsure how tariffs and all these other things were going to play into the equation, we were in a general kind of liquidity-starved type of environment and a risk-off environment, which is obviously inherently bad for a liquidity-driven asset class like Bitcoin. And that has obviously shifted again, if you see the kind of the April-May rebound that we saw, into a general risk-on environment that lasted about a month and a half, with the occasional risk-off environment as well. And it kept flipping back and forth. And you can see that the closer we get to today, the more sporadic that risk-on-off kind of environment became, right? Very difficult to have a structured long-term position if you constantly have to rebalance and readjust for new risk expectations. And this is obviously generally not a good thing for crypto, right? So it turns out that in October, right, when we were going into a new risk-on environment, this one here specifically, we got the news from Trump, right, that he was going to raise the tariffs on China to 100% on top of what they had already been paying, right, roughly around 60%, if I remember correctly. And that created a massive shock in terms of how the market was pricing risk. And ever since then, we have basically converged not only in a local, the biggest volatility spike that we've ever seen in the time that we've traded, let's say the crypto markets at scale. We had a 5 sigma event in a 30-minute time frame. So somebody basically blew up in that period. And what we've seen ever since then is a general risk-off environment that converged into a unwind of these players that were basically, that had a hole in their balance sheet, right? So these are market makers, large entities that basically were not able to recoup or to get basically raise new capital to be able to cover the balance sheet holes. And I think in to some extent, we're definitely seeing that those two things converge. Well, on the flip side, like Henrik said, we are definitely getting closer to a resolution of that event. And I'll quickly skip or forward into Hawkeye to make this point a little bit clearer. As you know, we, on the structural side of the equation, similar to what Willy does with his analysis, we care a lot about the areas in the price structure where people become very sensitive to price changes, right? So what those usually equate to, and what this risk-off signal is basically measuring, is how people are profit taking or selling out of a position, even at a loss, with a large unrealized loss, to be able to basically move money to the sidelines and wait until the volatility subsides. And we saw a massive spike up ever since the early parts of November. So even October, during the massive volatility spike that we saw, we hadn't really seen a structural shift yet, but we started to see that towards the end of October, early November. And that's when, from our perspective, things really started to change structurally. That's when you really start to see people becoming very uncertain, very scared, and they started to sell into weakness. And what we've basically seen up until today has been the net effect of that selling, right? So continuous structured selling, in part retail, in part directional longer-term holders, but also these large entities that were unwinding positions to be able to raise capital. And what's interesting as well is that we've now reached the extreme level on this risk-off signal, which is similar to not exactly what we saw in April. This is actually more extreme, because in April, we only came up to about 80 roughly, and we had a strong decline from there. But we're seeing something more similar to what we saw back in September and in basically the July, August area. Okay, so very volatile, super intense sell-off in markets where people were selling way below the price of acquisition or the cost of acquisition. But what happened back then was a fast return to normal as well. So a very fast, like Henrik would say, a V-shaped recovery. What we don't know yet at this point is if we're going to see something similar to this, or if it's going to be more similar to what we saw in 2023, where a situation like the one that we're seeing now could also result in I think this period here it started in August, went all the way to September. So this is about 4 weeks worth of negative environment. So very, very heavy. A lot of people forget how intense that period was, but it also set us up for the next leg up, like Willy and Henrik are saying as well. So it remains to be seen where we are. I think there's a lot of indications that we could be seeing something more similar, let's say the mid part of March 23, the mid part of, or let's say the early part of July 24, September, early September 24, and potentially to some extent also what we saw back in April of March, April 2025. In terms of the actual capitulation as well, because I think this is another key point that a lot of people have been asking for or information on, is the fact that we're getting quite a few indications of an actual altcoin capitulation. Even though I think the real capitulation happened on October 10th, which was here, we're starting to see movements as well. You see here we had 6%, so we're looking at this measurement here. You had 6, and now 8% of all the altcoins have negative impulse, like very strong negative impulse, similar to what we saw in August 5th of last year. So again, July 4th. So July 4th was a really, really important capitulation moment because you had the risk-off signal like I showed before, and the actual impulse also all converging. The impulse, again, is measuring, for those of you that don't know, is measuring the 350 liquid coins and is measuring how exponential the basically the trend and volatility component of that asset is, right? So how strong does the momentum go negative or positive in a very short period of time, which usually leads to euphoria on the upside, but capitulation on the downside. When you look at our, just structurally as well, which I think is important, the last time that we really saw this, it was similar to what we saw in April as well. So you had this capitulation event, you had that risk off signal really going up very quickly, and you had 2 different capitulation events on altcoins. Very different this time around, because I think October 10th was so intense that it took out all the liquidity. Also, part of the reason the alts are not really selling off as extreme in relative terms as Bitcoin and Ethereum are, because there's a lot more liquidation to be able to go through, which is maybe now also coming to an end. But it's interesting that there's quite a bit of a comparison there. Last year, I think the alt season was a lot more predominant. I think this year we haven't really had a persistent alt season other than certain narratives really picking up. And you can see that here as well. So if you do a quick comparison, we're now, or since early October, which is when we can measure the really big change in narrative, we've had a dominant privacy narrative. You can see that basically pretty much from October 3rd all the way to now, it's all been about privacy. The last time that we had this was also, ironically, in periods where we've had big capitulation events in the market as well. So this is usually a sign that you have a risk-off type of environment, and also a sign that the incumbents, so the people that hold a lot of Bitcoin, are selling and divesting to other things, right? In part also privacy. So there's a link between those things that are not irrelevant. And when it comes to our, let's say, structural momentum signal, it also shows what we look at here is there's basically a gray, a blue, and a red curve, which are the gray conservative, blue moderate, and red aggressive. We look at the different types of momentums that are in the system. You can see also that since October 10th, pretty much October 10th, 11th, there has really not been any positive momentum. It's all been negative, right? Which again coincides with this risk off and capitulation regime. What does that mean for, let's say, the next phase? I think, like Henrik and Willy have already said, what this is really showing us that we are is that we are really in an extreme situation.
Can I just say, I think there could be an incoming reversal daily candle on Bitcoin today. Let's see. I like the momentum and the strength we see right now.
I mean, we are in an extreme situation now. It's oversold on many different levels. Yeah, there's also one other point to be made to kind of reiterate what Willy said before. Bitcoin is obviously driving the behavior, and I think the flows are indicating this as well. But what is interesting is that ever since we had this capitulation event where Bitcoin really started to go off a cliff, right, in terms of the mechanical unwind that we've discussed previously, we've actually had relative strength in mid-caps. So there's been a lot of relative rotation or relative strength in things like NEAR, Zcash, right, things of that type. And that is fairly persistent. We haven't really seen that sort of persistent move up. The last time that we actually saw that was in the September period of 24. And we also saw that in the lead up to the early January, February rally of 2024. So this is basically at the end, you can see here in the late parts or the late parts of December 23, that then resulted in a collapse of Bitcoin as well. If you guys remember, this went from 46 all the way down to, I think, 38 or 39, right? So it's a fairly big relative collapse. This was around 12, 13%, with alts taking the brunt of that as well. And then that kind of set us up for the early rally into the ETF announcement, right? The announcement, I think, coming out sometime late 24, if I remember correctly. I think that was the bottom. So again, market is very sensitive to changes in expectations that can very easily flip in the opposite direction, especially in these oversold environments. From the last time that I checked, we were If you look at the last 30 days in terms of how short and long liquidity has been positioning, there's about 15 billion worth of shorts that get liquidated if price moves up to 103,000 roughly. That's pretty significant, right? So there's a lot of pent up liquidity that is being stored up there. What we want to see, just to the point that Willy made before as well, we do want to see more strength into Ethereum. So I like the fact that there is relative strength or relative strength pockets in the system, but I don't like the fact that we haven't really seen a consolidation, because we need Ethereum and Bitcoin to start reaching over certain critical levels, which is around 86.5 on Bitcoin is the first major important level. And then the other major one would be around 96 to 98. That's when the volatility starts skewing to the upside, which is important because that would mean that a lot of the trend followers and a lot of the trend-based traders are going to start basically using that as a green signal to start allocating again. So we need a lot of strength, and that usually happens when you consolidate back to Bitcoin. You can see it here. Let's say the 7th, 8th of April this year, we had consolidation in Bitcoin. Same thing here, consolidation in Bitcoin. Same thing here, consolidation in Bitcoin. Same thing here, right? Over and over again. So this is important for a reset to then redistribute that capital into the other place. It doesn't mean that you get a massive sell-off in alts, but it means that Bitcoin is leading the charge again. And then we would want to see, for a healthy setup for a potential alt season, we want to see that consolidation and then that rotation into Ethereum, which is what we saw in the lead up from the April lows this year as well. So you had a short pocket of alts, right, small caps in this case, but we had the rotation to Ethereum, which was very long, then a back and forth Bitcoin Ethereum, and then a very long Ethereum period as well. That led basically into the short alt rally that we had towards, let's say, the late parts of September. One last thing to the point that also Henrik and Willy mentioned, we have a very clear indication that we've been rotating from a environment where positive news is good news, right? Where macro data is really pushing Bitcoin in the right direction. Same thing with basically external factors, right? So on-chain, idiosyncratic, and also factors. But we've now moved into an environment where Bitcoin is very sensitive to external factors. So you can see that we're lowering into this quadrant here, which is not positive. We want to make sure that it stays in this left quadrant, or ideally moves into this right quadrant, which is where it was for, let's say, the predominant period of this rise. So this is something that we will be tracking very, very carefully. And this basically means that we're very sensitive to external factors. So Bitcoin right now is dealing with a double whammy: internal sell-off, but also external factors and external negative information, creating a negative feedback loop on the price. I don't know if you want to add anything to that, guys.
Would say that there's a few things that don't really fit if this is the top. And one is liquidity from spot markets is holding in relatively strong, and the paper markets have died. Generally, the top, certainly the last top, was spot investors. These are the long-term investors. That liquidity starts to dry up, and then you get the short-term liquidity coming in that want to ride it for a short time before they get out, and that's usually the top. And we haven't seen the paper markets, the shorter-term liquidity come in, and it's the longer-term liquidity still holding up. And the second thing is we really want to see Bitcoin liquidity peak and then Ethereum liquidity peak afterwards, as people chase returns higher up the risk curve. And we haven't seen that. And so it would be very unusual if this is the top right now. I do expect that we'll get one final rally, and everyone has been bearish leading up to this. And you really want to see a little bit more sentiment towards bullishness. So currently, everything doesn't fit the standard pattern of the top.
Yeah, I would agree with that as well.
Questions now, guys? Or
yeah, let's go into some questions. From Vic London: what does Willy Woo think of Henrik's prediction that BTC will crash and burn forever after a last rally?
Forever? Is that the prediction, Henrik? I didn't know you predicted that.
That I said. I think I said. Let's try to be precise. I said there is. Let's put it like this. You're seeing Bitcoin now declining from 150 to 25,000 to, what was it? I don't know how long it was, 80,000 maybe, right? Because of almost nothing. Bitcoin has never seen a crisis, a real crisis. It has never seen credit crunch, dollar soaring into something like what I expect it to go to. Market selling off. We have the tech stocks are now so highly valued. The valuation is just crazy. You could easily see a 60-70% decline in the NASDAQ. And if you do that and you see the combination of that, I mean, I just have to say, it doesn't take a lot of fantasy to think that Bitcoin can crash to 10,000 or below. I just think, and technically, it is the case. It looks like it should be the case. Will not say we do. I say it has a task to do to prove itself in a recession. If it can prove itself in a recession during a big city rally and during a stock selling off 60%, 70%, 80%, as we saw on the dot-com days, well, then I could change my mind. But I'll stay on the side of caution at this point here, because if you look at it, it is extremely volatile to small declines. Nasdaq was down, 7, 8, 9%, 8% this time. And Bitcoin is down almost 40, right? 35. So don't rule it out, guys. I mean, look at it, look at the facts, and then say, we'll have to see. I don't care about everybody telling that this is the salvation of the world, because it doesn't show. Every time it needs to stand up and show the strength, it shows weakness. And everybody talks about it around the corporate world. Well, everybody talked about all the dot-com businesses back in the days, and they were wrong about most of them. So, don't get fooled and just look at the facts we have. So I don't know really but that's what I said. I said it has to need to prove itself into something of a real crisis.
Yeah, I think Henrik is right and wrong at the same time. I think in the short term, yes, it's very volatile and it's very sensitive to liquidity. And if we get the collapse that we think we're going to get, I think it's going to be another sort of standard drawdown of 80%, maybe more. We're going into untested waters with this coming bear market, just because it's the end of a very much more longer term cycle. I think Henrik's wrong in that it's worthless. I think it's a replacement to gold. If you think of gold, it's really misunderstood. Gold is a ledger. It's a decentralized ledger. It's the best technology we had in an agrarian age 6,000 years ago. And it's also had 6,000 years of burning in of time. So it's really trusted. If you look at institutions, sovereigns, very large liquidity pools, something that's like 16 years old, like Bitcoin, doesn't even register, right? How can you understand something that's only performed in 16 years? Real estate markets, 10,000 years, gold, 6,000 years. This is, conservative liquidity pools need time to understand it. It's also the youngest.
It's just not acting. It's just not acting like gold. It actually opposite gold.
To that point, it's the smallest of the global macro assets. It's only entered the $1 trillion club within the last few years, last year or two. I think it's the last year. So effectively, it's the tiny little, you think of a 6-month-old versus an adult. It's going to be thrown around and buffeted around until it gets to size. And also, there's a lot of challenges ahead. It's got to get through the quantum stuff. Who knows when we get through that? Maybe it's going to be the next 5 years, next 10 years. I think there's a lot of fear in the market around that. And so you've got the size, you've got the sensitivity to liquidity, and you've got structural, worries around like maybe up to 6 million Bitcoins may be stolen and dumped onto the market. So I think that's going to take a decade to get through. So we're going to have a volatile ride. Also, I think we're going to have a decade of chop in equity markets. And so, but I do think long term it is a replacement to gold, because gold's got an inflation bug and it will die within the century. And the markets will price that ahead of time. And Bitcoin is the leading contender for that, to be the decentralized global ledger.
I just think that they work in opposite direction. I'm not sure that you're going to see that in an inflationary world that Bitcoin will do well necessarily. And we have seen also that they act differently, also in the way of the volatility of things. I mean, I can't remember where gold has ever dropped by 80% in a matter of, or 60 or 70% in a matter of 4 to 6 weeks. So I think there is something to gold that is different completely. And I think people would like to say it because there is this thing that there's a shortage of supply. I mean, it is really down to and also if we move into what I think will be a stagflationary world, there will simply need to be some kind of cleanup. And there's one thing administration would not like, and central banks would not like in that situation, would be to have something where money can run around the system. So I'm not sure that there will be, but you have to see. And as I said, there will be a big test in a very big crisis that I think we're heading into. But I can see everybody thinks I'm not understanding it. I'll still dare you all, guys. Let's see into a crisis, into a recession with a deflation, how low it goes. Wait with the clever words until then, and then see how low it goes. Because right now we had nothing moving, nothing really, and we are still seeing 45,000 decline in a matter of no time.
I mean, that part I agree with. I think that Henrik's right on that. It'll crash quite hard, but I don't think it'll burn. It won't go to zero. It's not worthless. In fact, it's incredibly valuable if you look out past the next decade. It just needs to get to maturity.
Yeah, I agree with that as well. I think it needs to get past maturity. People need to understand how to position in a portfolio, because with the majority of banks, asset allocators, portfolio managers, they all look at it as an alternative in the alternatives bucket, right? So it kind of gets lumped together with gold without really understanding what the benefits are of actually having them in a portfolio, and also the downsides of having it, right? Especially in a liquidity-driven environment where if that liquidity tends negative, it can have serious consequences at scale. But yeah, sounds good. Let's move to the next question. You have been tweeted earlier today that 10th of October 2025 caused a cascade potential triggered one of the counterparts who turned into forced seller. Since we had no extraordinary trigger, your theory could have legs. Could you please elaborate? It's very simple. I think the names are starting to come out. I'm going to have a couple of conversations with people that I know that are in the delta neutral, let's say, space, that have said that there were some major balance sheet holes, and I have a feeling that part of that balance sheet hole has been basically that restitution has happened through the selling of actual assets, and I think that just has coincided. Remember, we never really look at red herrings, right? So it's never one thing that drives the behavior. It's always a couple of things together that tend to create the outcome, especially catastrophic outcomes like the one that we've seen here. But it's really a combination of both. It's a combination of unwinds, but also, like Willy said, the fact that we're correlated to equities, and we just happen to be in a risk-off environment ever since late October. So those three things just happen to coincide, which made it a double whammy, as I would call it, just a double negative, which is unfortunately not a positive in this case. Rob C. Oh, and by the way, there's also the stuff that Willy always talks about, right? Treasuries that unwind. You just got a taste of what that's going to look like. To Henrik's point, once shit really hits the fan, I mean, yeah, you don't want to be in the room for that one. Hi all, Bitcoin Vector subscriber here. A question for you all in the Q&A. What timescales do you each see for enough new liquidity entering the main stock markets to move the indices up? Days, weeks, months? I have a feeling it's going to start moving. I mean, you saw today, right? So you had Williams that came up, so one of the Fed board members, and he basically said that he could see a situation where they are open to a rate cut. And I think that single-handedly reversed the expectations. We went from a 20% odds on the CME Fed Watch tool to 71%. I haven't checked in the last 30 minutes, but before we came on.
73 now, Jan. So that's
73 now, exactly. So 73, so now there's a high probability of a cut versus, and literally 2 days ago was the exact opposite. On top of that, you had the AI scare, right? All of a sudden, people are questioning, are the hyperscalers really hyperscalers? What about Oracle, right? And I think maybe, Henrik, if you have the graph there, very interesting one to look at. There's a reason why the swaps are going up, right? The CD, the credit default swaps on Oracle. Yeah.
I don't have the credit default swaps. I think I have Oracle somewhere.
I don't want to make it about that, but I'll make one comment. The AI narrative and the musical chairs of, this underlying problem of, revenue being booked multiple times, right? Where it's not clear what is actually revenue, what is actually owed, what is being borrowed, what is being lent. In this cycle will keep going until one of the pieces of that chain breaks. And it turns out that weak link, so to say, in the chain could actually be Oracle. And that's why people are especially concerned about, looking deeper or closer at the numbers to kind of see if this is actually all, too much of mark to market. If you remember that name or that word, it was very linked to the Enron collapse in the fallout in the 2000s, right? They also were the Nvidia of the time, kind of, the emperor with no clothes. They used to have a saying for the board members of Enron and the C-suite as the smartest guys in the room, right? There's a little bit the vibe that I'm getting with this AI stuff. It seems like everybody knows more. I always feel like I'm missing something. So there's definitely something going on there. And that is probably also linked to private markets. I would assume that there's something happening here that is going to come out within the next 2 to 3 months and is also likely to converge once the new quarterly results, the Q4 numbers, come out in January, February. And the reason that's going to be important is we're going to see exactly what those maturity cycles of those loans are going to look like and what amount of debt actually gets rolled as well. So very, very important. Yeah. Henrik, maybe explain this graph.
Yeah, you just see the Oracle chart here, right? And again, we look for the elevator, and we look for the stair. I just saw it yesterday, actually. It was one of our great analysts. God is also Oscar who saw this, and it's just something
PMs actually.
not right. PM, sorry, yeah. And we see how it's just accelerating here. And the next level for me is around 160 something here. So if we see that, then it's definitely that's a top. That's a big top one. And that is long term. It may bounce, and I think it will, but it's getting in a very, very big top, and it's just started to feel that these Eiffel Tower structures that we also have for NVIDIA could start to roll over simply. So I think we are in a fair market option or an oracle here, and things are starting to unfold. But also, Jan, if I may add also to why you see the Fed doing this, is because also this, but also because of the situation in the labor market, because the labor market is not strong, and they have to see that also with that. That is, after all, their second mandate also, or one of their mandates.
Exactly. PMIs, they come in higher, just for those of you that haven't seen it. So which is also, it's also good, right? So it's staying at around, or it's actually above 50, which is what you want to see for potential kind of reacceleration and growth. So that's also, again, short term, it fits within the narrative of, okay, the economy is still working well. You have higher unemployment, which is obviously a reason to cut and to ease. And also the fact that now you have tighter liquidity conditions, which hopefully with the end of QT, beginning of December, starts to wane as well. Next question. Not so much a question. I value Henrik's view and their founded numbers or educated guesses, but it seems extreme to me. I think, opinion of fact, fiscal stimulus and China-style government intervention into real economy will dampen this downward spiral. Yes, I think now, right? So remember that markets always anticipate these events. So once they hit, it's usually a sell the news event.
So I think we need to say also, guys, that if it was like this, that central banks and administration could actually save the world, save the economy, save the markets, why would we ever have had a recession? Why would we ever have had a market crash? It's not that simple. And this time, again, there is a difference. We're starting to see inflation coming into the world. We've seen inflation being, come into the backbone of people, which means that they will start to expect inflation to go up. If that happens, then stimulus will not have the same effect because they will also start to trigger inflation, which will be bad for the consumer. So don't think that it's that easy. We can't just sprinkle money on everything. If it was that easy, then you would never ever have had a recession or a crisis. But that is what we have been led to think in its inflationary development over the last 25 years.
There's also one other point, Henrik. If you look at commodities, so basically non-industrial commodities, if you look at, I think sugar was one, cacao, all of them sold off today, big time. Oil is also 57, right? So that's usually not indicative of rising inflation. If anything, that's the opposite, right? Because that has a direct impact on inputs for housing and building, and also obviously on the basic basket side and on the soft, let's say, commodities, you have basically a direct impact on the prices going down, not up. So I think if that persists, the inflation story is just not one that I can stand behind. I think at this point the issues are much bigger. And to what Henrik always says as well, inflation rises into a recession, right? So prices tend to go up into a recession, not down.
Yes, they do. That's where they are lacking, because there is the supply chain. They make sure that we don't see the immediate effect of things. So you can just think of it from the commodities going into different warehouses and so on before it becomes a product to the consumer. And that takes time. It takes time to go through the system. That's why we can use inflation as a leading indicator. But also, if you look to oil right now, you can see how that is actually down a lot. We're down 57. So. We're down this month by another 5%. So oil is declining. Why is it declining? Because we have a deflationary impulse, right? That is what I think is so simple. Look at the various commodities as they're starting to show weaknesses, and they will see that into a deflationary impulse. So if the central banks and the administration could keep markets up forever, they would, but they can't. That's the problem.
Yeah, and it's also the expectation of liquidity, right? That's super important right now. What does Bitcoin have to drop to? What time period has to pass before final melt-up happens for you to change your mind that cycle is different this time? Or if the final melt-up doesn't happen, what would change your mind? So what is the kind of the threshold?
Probably me, yeah. But it's not a threshold. Everybody thinks about a threshold. What is the line? I mean, if you think of the markets like that, first of all, it's never a line. I know that's what traders do, but you don't do trading if you understand macroeconomics. What you see is that there will be, the Bitcoin can decline for certain reasons. And of course, there will be levels where you can say, okay, then it makes no sense to have a certain count on the yellow wave. But in order to change my mind, I would see the dollar having to rise strongly, go above 102, let's say. I would need to see that yields are starting to decline very sharply right now, right here, and do that. And I'll have to see that equities also rolls over very strongly in other countries, not just in the US. I would like to see the sequencing of things. I would like to see my imminent recession indicators, the yield spreads, the credit spreads, and so on, starting to show weakness, which they don't. So before we see that, people say you look at the market. If you just look at one market, you say one line. I mean, I have to say it's a bit naive. You have to look at the most, all markets that you can, commodities, bonds, everything, and look at this normal cyclical behavior you have in the economy and what you need to see in order to have, let's say, now things up. Remember, the Titanic has hit the icebergs. The passengers on third class are getting their feet wet right now and saying, hey, there's a problem. The passengers on first class are still start debating whether we should have a gin and tonic or we should have a rum, at this point, because they don't see it. And this is the problem we will see. But it can take longer before the first class passengers start to see it. And until then, we can see the music continue to go. And there'll be more and more indications of problems in the system. But for now,
I think the dollar is going to be important, right? The dollar is probably going to be the most important.
The dollar is the trend sign. That is at the center. Yeah, exactly.
Yeah.
If the dollar goes to 102, 103, then it will start to be a problem. 104, then it'll be a problem. Then it's over.
Exactly.
The question is really what is the confirmation that we're not going to get the bounce and we're in a bear market. And
right.
I think it's clear to say what Henrik is saying, what I will say, what Yann would say is that we don't actually look at price so much as we're looking underlying fundamentals of what's happening, because that's much more predictive. So for Bitcoin to drop, I need to see liquidity drop away, like make it go negative, go lower low rather than a higher low, right? So the trend needs to go down, and that would be a confirmation. The taking the technical analysis is kind of a little bit like it's very direct, but it's basically the outcome of the fundamentals through its own sort of resonant patterns. The price likes to behave basically based on past fractals and past behavior, and that's what we call technical analysis. And people put their positions on accordingly, and so it sort of recreates it. But effectively, what we're talking about is the engine house that's driving how it expresses into the price domain. So really, the answers you're going to get we need to see the fundamentals break down.
Right.
Yeah, 100%. There's also another question that is maybe a follow-up on the DXY. So what would actually push the dollar lower? What are the factors that would do this?
Well, I mean, we know that if the Fed comes out and lowers rate, then there'll be a relative, spread to other rates around the world. But everything else being equal, you'll see that then the dollar will, get weaker. So that could be that if Fed comes down now and cuts again, that can be one thing that comes to send the dollar lower. There can be various things. It can also be some things that is happening in Japan. It can be things that if Japan steps in and do something also to intervene, then it could be that the dollar will actually be pushed lower versus the yen. It can be the same in Europe. So it's not just one thing. That's why it's a very complex thing. And the DXY is composite of the British pound, the Japanese yen, the Swedish krona actually also, but mostly of the European so the euro. So there can be different things. That's what I want to say. But obviously in the US, things where the Fed starts to become more accommodative will send it low.
Yeah, and it's also, I think, direct currency intervention by the Japanese Fed, right? So we basically have kind of direct more open market operations. I think that can put a stop to the weakening of the yen, which is going to have a positive impact against the dollar, right? So it would push the dollar down. And it looks, correct me if I'm wrong, Henrik, the euro is also strengthening here relative to the dollar as well, at least in the short term. So that's probably another reason.
Yeah, exactly. It's had a couple of days up, and now it's to see a correction on that. But I think we have seen the bottom to this time, and we see that the euro is moving higher versus the dollar now, and that will set the direction for the dollar.
Yep. Next question from Ahmed Hussein. How do you evaluate the unprecedented hike in Japan bonds and how it may impact the overall global economy, especially if situations evolve with this fragile and volatile market? I don't know who wants to take that. I have a couple of points on it, but nothing major. I think the biggest concern that I have is the repatriation of capital. So you have to understand that Japan has been the source of cheap capital for the last 20 to 30 years, right? For the global market, where people would, that's why you had the issue with the carry trade last year. People borrow in yen, use that money to invest in foreign markets, and then kind of repay using stronger currency in foreign markets to repay weaker, let's say the debt in the weaker currency. Now that the rates are higher, the actual incentive or the opportunity cost of Japanese companies, to invest in the US market goes down significantly, because they can actually get a similar type of yield in local, basically local custody, using local bonds, investing in local, let's say, treasuries, which changes or flips the script a little bit on its head, where you don't have an exodus of capital from Japan into foreign markets, but the actual opposite happening in the opposite direction. A small piece of that could actually already be the situation with SoftBank, that sold a big part of their NVIDIA holdings, or actually maybe all of their NVIDIA holdings, to repatriate capital. Maybe that's part of that kind of re-exodus in the opposite direction. We're going to be tracking that fairly closely, because I think that can definitely be a net negative for liquidity in US markets. So the question here is, does the new kind of reinvigorated liquidity injection from the Treasury, and let's say the fact that the Fed basically incentivizes banks to convert their treasuries into actual currency, right? If that happens, that obviously stimulates the economy, but is that going to be enough to offset? And I think this also maybe ties into what Henrik said before, of other stock markets potentially topping out earlier, and then that capital rotating into the US, right? So there's always these different flows that need to kind of, there's a net effect, and that's, I think, the real question, how that's going to look like. Is it possible to many people's finance outcomes to rely on your framework? How confident are you in another leg higher before the deflationary bust? Is that a 60-70% probability? And that would invalidate it. I think, like Willy said, I think flows are going to be the thing that give us the best view of what happens in the immediate future, 4 to 6 weeks. What do you think, Willy?
Yeah, if I was to sign a number, it'd be rough. A new high before the bear market hits for Bitcoin. I'd give it 35%, but bear in mind I'm the bearish out of the three of us here. Give it 35% that we'll get a new high.
I'm of the idea that we get somewhere between 115 and maybe 124, like retest or lower high. I think that seems to be the most likely. I think Ethereum definitely has more to go. I'm more bullish on Ethereum than I am. Yeah, I think Ethereum, yes. I think Ethereum, the likelihood that it goes over its previous all-time high is very, very big, I think. Bitcoin, yeah, we'll see how that plays out. I'll go through the last couple of questions. What's your invalidation of Bitcoin, Henrik?
I don't, I mean, again, I don't work with validation like that. I work with, as Willy said before, with the fundamental structure based on everything breaks down, then it's a different picture. Then we have to, then it will be invalidated. But it's not down to one line. People thinking that that's not macro. It's about yields. It's about the dollar. It's about everything. And there's no, we're not even near to that validating things there. We are actually very, very clearly on something that supports higher levels. And can I just say, I give it a 80 to 90% that we get to 243-ish area of Bitcoin.
Okay. Next question, or let's say we'll do two more and then we'll answer the rest through the email like you always do. There's a question around the volume at this current level and how that leads into all the people that bought before the Trump election at the 60, 70K area that are now very close to their actual realized cap, so to say, or let's say their average cost of acquisition. How do you guys see that? Like, is that something that we should be concerned about? Willy, I think that's a very good question for you.
Yeah, I'm not clear on the question. Last one from me. There was a huge volume surge pre-post. It's a very dynamic market. I think that we can't just tag it on to the Trump event. I'm not a big fan of like predicting like what buyers or holders will do to then infer price, because you're kind of like trying to make a guess at what these guys will do before they do it, before it expresses itself in price. I'm more in what are they doing right now? Fundamentally, track that, and then now look at how that expresses in price. That will be a leading indicator, still out by number of weeks. And so there's all manner of uncertainty. But if once you get back into this, like what will these guys do? And then when they action it, I think there's so many uncertainty, it's not very predictive or accurate. So it can lead you into trouble. So I'd probably invalidate you might be different there, yeah, but I invalidate that method of looking at things. Yeah. I'd rather look at it as they're doing it and then make a decision. of course, it's a risk signal. I take it as risk.
Yeah. Could I actually, for the last question, because I think this is something that I saw a lot of thought build up on Twitter around the situation with MicroStrategy. And I think the last question from Juan kind of asked that. What do you guys think of this risk, MicroStrategy, MSCI risk? MSCI may reclassify MSTR as a fund, not a company, could force billions in passive selling from ETFs, index funds, 9 billion of MSCR cap currently passive owned, major outflow risk, selling began post October 10th announcement, still underpriced by markets. Risk is broader, other index bodies may follow MSCI. Since you've obviously studied this more than I think myself and Henrik, what is the actual elephant in the room here? And what about the actual selling pressure coming from MicroStrategy? Because a lot of people saying that they're going to be forced sellers under 74,000. Is that actually true? Do they misunderstand the mechanism?
I mean, it's not exactly the question, but they're not going to be forced to sell it at any point until 2027. Because you're going to be forced to sell if the bondholders want cash instead of converting to equity, and there's basically a strike price of the equity. The next window comes up 2027. If so whether or not MicroStrategy and Bitcoin recovers, before that, that price is around $183 per share in MicroStrategy. Best estimate with the current setup and what they hold in Treasury. 2027, and 2028 is the big one because that strike price is much higher. And so the interesting thing here is that all of 2026, if we get a bear market, they don't have to sell anything because those bondholders don't get their window to demand their cash until 27. 28 is the one where the price, off the top of my head, it's something above 600, close to $700. So if Bitcoin price does not recover fast enough in 2028 to get MicroStrategy up to that point, then they would need to probably refinance if it's a bull market. Otherwise, they may be forced to either ATM and sell their stock and pay them, or liquidate some Bitcoins. I highly doubt that Saylor would liquidate Bitcoins because that would undermine confidence in his whole promise to shareholders.
Okay, understood. I think that makes a lot of sense. And also the MSCI, the risk of basically it getting kicked out of the let's say the index it seems like is there, right? That's a real risk. Willy, or how do you see it?
Yeah, I think that's a real risk. I've been thinking it should be classified as a fund, not like company. Yeah,
okay.
It's
and
like
this
hedge fund. Yeah.
When would that happen? What's the actual date where that would be decided? It's sometime in January, if I understood correctly.
Yeah, sometime in January. I don't know the exact one. Weeks away. Yeah.
Yeah, so I actually would need to double check that. Sounds good. For those of you, just before we actually wrap up the webinar, for those of you that actually want further feedback or information around any of the topics that we discussed, we have on swissblock.net-products, you can find a whole suite of different frameworks that we use that are also kind of extensions of what Willy showed, what I showed, and to be able to kind of answer some of the structural questions in a much more linear and kind of digestible format in the forms of the Bitcoin and the altcoin vectors. And we also have the SEM suite, which is what Henrik is basically leading, which is a very, let's say, very strong or very broad deep dive into the macro markets and cross-asset narratives and understanding how all these different things are moving as well, which I think is especially important, not just now, but I think also leading up into 2026, once things really start picking up in terms of volatility. And there's also another question from a webinar where I showed a time series or a track record of a momentum-based signal that we have. And there's been a lot of people asking for that question, or asking for access to that signal. If you are an accredited investor and you're interested in getting and are interested in actually investing in that sort of vehicle, we're actually doing a partnership with a very renowned fund based out of the US that is actually going to be incorporating that signal into one of the strategies that they're going to be building. So if you're an accredited investor, please reach out through the email like you've already done for those of you that were interested, and we can connect you directly with that entity. This is a question that came up about 50 times. That's why I wanted to mention it. Super. Thanks a lot, guys.
Okay, guys. Where are we next? Let's do this.
Yeah.
When is the next time? It's in a month's time. We'll do this, right? Where is Bitcoin at that point? What do you say?
In a month's time? I think we'll do one early December as well. right?
Yeah. So
Next
so
one
where
to
are we there?
January.
Where? Okay, early December. Where are we? 2 weeks into December. Where are we there?
Ethereum or Bitcoin? I'm more convinced
Bitcoin.
it will be close to all-time highs on Ethereum. Bitcoin.
But let's
hard to
do
say.
Bitcoin. Where's Bitcoin at? We say we also just do Christmas. Where are we at Christmas?
I would say above. We'll have seen. I don't know if it's going to have already topped up, but we'll have seen at least 110,000. That's what I would say on Bitcoin.
Right? Willy?
Yeah, exactly. I was going to say 110.
And I'll say we are in the range of we are above 130,000, pushing on 140 when getting into Christmas on late December.
Sounds good. But I think
Okay,
Ethereum, I'm more convinced that we see an all-time high there in that same time period. So maybe like 5,600, 6,600, somewhere there.
Right. Good. Excellent. Thanks, everybody.
Thanks a lot, guys.
Good to see you all.
Bye-bye.
Bye-bye.
Great. See you, mate.